Thank you. Rookie mistake.
Awesome. Thanks, Rob. Thanks, Alla. And thanks everyone for joining us here today. So today we want to go over financial forecasting, how to build a forecast that investors love. As Rob mentioned, as far as questions go, if you want to submit them in the chat, interrupt me. I like any and all questions, and I can take them during the presentation as it's top of mind, or feel free to keep them till the end, and we can answer them then as well. All right, so just a bit of a quick agenda of what I'm looking to go over here today. So, at first, I want to talk about how to think about finance strategically. Then, we're going to dive into the main topic of our presentation here today, which is financial forecasting. That's how to build a model using key drivers. Then, we're going to talk about analyzing that forecast and how to use key financial KPIs and then benchmark it in order to do that. Then, how to manage this forecast after you get investment. And then finally, how can Profitual help? So a little bit about myself. Rob mentioned I'm at a startup company right now. So I'm the CEO and founder of a company called Profitual. We've been at it for about 3.5 years, have 5 full-time employees. We've raised about 2.5 million for the venture since we got going. And our whole purpose is really to provide financial intelligence to non-finance founders. So we really want to work with founders regardless of background and make sure that they understand the main drivers of their business, how they make money, and how to make the best decisions backed with finance. Before that, I would have worked as a pre-seed venture capitalist at a firm called NBIF. We were a small venture capital firm, average check size of about $250,000. And by the time I left, we had about 75 portfolio companies that we had invested in. If you're not on the high tech side of startups, I do co-own a bootstrapped, very traditional company called Devil's Keep Distillery, where we do vodka, gin, and whiskey. And I can tell you that's come in handy, having free access to alcohol as I've been going through this startup journey at Profitual. And then finally, I am an instructor of finance at the University of New Brunswick, both in the engineering and the business faculties. So first, I want to talk about what does it mean to think about finance strategically. So finance, unfortunately, isn't something that you start and you finish. It's really a continual evolution that runs alongside your business. So you're not really too early or too late to think about it. And that's one of the things when we talk to really early stage startups, they think like, oh, I'm way too early to think about this. And that's not really the case. You're never too early. That's because thinking about finance strategically isn't thinking about it, the way that gets the accountants excited. So, accountants get really excited about debits and credits, amortization schedules, and all of these, accounting things that are really important for them to do their job. But as business owners, those aren't really the things that we need to think about in order to make money. So that's really what we're going to try to focus on here today. It's not the accounting and the debits and credits. It's really about the main drivers of your business and how you make money. So thinking about finance strategically for me would be that as a business owner is making a key decision, say like hiring an employee. Well, that's exciting hiring an employee. You're going to bring someone new onto the team. They're going to do all these new tasks for your company. But we want to have finance in the background, in the back of that owner's mind saying, yeah, okay, it's great we're hiring this employee, but that's probably going to increase my burn rate. That's probably going to decrease my runway. So having finance just in the background as you're making these key decisions is really the goal. So not going to turn anyone into a CPA today, but we're really going to focus on the main drivers and how to think about your business strategically from a finance perspective. So in doing that, we're going to really focus on financial forecasting. So to start off, why do I need a financial forecast? First off, it's to prove that your business makes financial sense. There's a million ways that you can make money in your career, and I can guarantee you running this startup won't be the easiest. So, who wants to spend years of their life working on a startup that's destined to fail financially? So, this is a very real outcome of financial forecasting. It could actually tell you to stop. Hey, this business, the way you're thinking about it, doesn't make financial sense. It's probably not worth spending the next however many years of our life working on it. More likely, though, it's going to tell us, okay, here's where your business is strong, but also here's where it's weak. and it will give you the chance to take a look at those weaknesses and make adjustments so that you're more strong in the end. And then finally, financiers want it. So from a financial forecasting perspective, banks ask you for your forecast. I've never met a startup company that hasn't been asked for a financial forecast from a venture capitalist. So I know when I was in VC, we always talked about need to have versus nice to have products. Well, if you're going to raise money, whether it's from banks or VCs, a forecast is a need to have product. So you need a financial forecast, but your forecast is wrong, and you just need to get over it. The goal of financial forecasting isn't predicting the future with perfect accuracy. No one has a crystal ball. But you still need a plan. And you need a plan because those that have one are 60% more likely to be successful than those that don't. So a great financial forecast is well thought out, but also provides flexibility to make changes since we know this plan isn't going to be right the first time we make it. Shows we are strong, but also areas of concern. Just remember, no business is perfect. The goal is to be a little wrong. And what I mean by that is, if you got an awesome opportunity today to go to a conference, 2 weeks out, and it's going to cost you $1,000 with travel and the conference ticket, and you know there's going to be a lot of value, so you decide to go. Well, that probably wasn't in your financial forecast. You just found out about it today. So, you're going to be off on that financial forecast. You're going to spend $1,000 more than you thought you were going to be. That's okay. Your forecast is a little wrong. You took advantage of an opportunity. That's great. Now, on the flip side of that, when I was an investor, we had this startup company that was doing really well. They had about $30,000 in revenue. They submitted their quarterly reporting to us. They said they had 12 months runway. Well, a few weeks later, we got a call from them. It turns out they only had 6 weeks of runway, and they were really concerned about making payroll. Now we needed to scramble and do bridge financings and find a way to get them out of this mess. So going from 12 months of runway to 6 weeks of runway, that's a lot wrong. That's what we're going to try to avoid. Overall, though, if I could convince everyone on the call that's, thinking about starting a business, if I could advocate for one thing, it's just start. So I said a lot of companies we deal with think they're too early to start financial forecasting. In my experience, that isn't the case. So the only way to make these things better is to iterate on them. So you just need to start. So hopefully we convince you this isn't that Herculean of a task here today, and we can get you off to the races. So what makes a great financial forecast? First, it needs to be comprehensive. And this can mean different things at different stages. If you're really, really early, sometimes the back of a napkin financial forecast makes sense. We're going to focus on a more advanced type of financial forecast since we're talking about ones that will go to investors. It needs to be accurate regardless of the stage of the financial forecast. So if you're used to Excel, we don't want any of those, hashtag ref errors. We also want it to be venture capital grade. So we want to make sure we achieve top quartile status for the important metrics. And we'll talk about what some of those important metrics are and how to make sure we're top quartile. And then finally, it tells a story. So as entrepreneurs, we've been conditioned to, perfect our pitch, make sure the story of our pitch deck is telling everything about our business. Well, what we think is really compelling is, well, your pitch deck tells a story. And if your financial projections can tell the same story about how you're going to be a globally relevant, super successful startup, well, the two of those things together is really, really powerful. And that's what gives investors a lot of confidence that you're the right startup to back. So, some key things to consider. We want to forecast all three financial statements. And this is our income statement, our balance sheet, and our cash flow. The reason we want to do this is twofold. One, the readers of these financial statements are used to looking at them in this format. So they understand what an income statement is and how it interacts with the balance sheet and the cash flow. So give them a financial forecast, in this type of a model makes it much easier for them to read and to understand. It also makes it easier for us to know if there's any errors within the financial model. So it's a really great validation point for us to use this type of a format, and it makes it a lot easier for the folks that are reading them to interpret them. As far as length's concerned, I love 3 years. So remember, this is a story that we're telling with numbers. 1 year doesn't do it. It doesn't tell us how we're going to grow revenue year over year. It doesn't tell us, how we're going to grow the team. So, having 3 years gives you enough ability to tell a story. I find once I get out into like 5 years, it starts getting a little too long and I start to lose some reasonability. I got a startup now that going from zero revenue to 20 million in revenue by year 5. Well, that can feel like a bit of a stretch. Now, I will put a caveat here, if you're a startup that maybe is in clean tech or deep tech, maybe a bit of a longer pathway to market. I have seen forecasts that go out to 5 years, and that makes sense. But in general, I really like to keep it to 3. Use a template to make these things. So, I'm a CPA, been doing this for quite a few years. I would never create a financial forecast from scratch. There's way too many places that you can make errors and have a model that doesn't tie together. So, make your life easier. There's lots of great templates available. I'll tell you about Profitual, but there's also great Excel models that you can use depending on the stage of your business. So, use a template. All right, how do we create these things easily? So when I think about creating a financial model and creating it easily, I think about focusing on the major drivers of the business. And at Profitual, we call these our building blocks. So on the left-hand side here, you'll see 9 different main drivers or building blocks. Things like revenue, team, expenses. If you can think about these 9 areas strategically, you can create a really solid financial model. When I take a look at these, when I'm working with a lot of startup companies, there's 9 of them, but then, I look at something like debt. Well, unfortunately, most startups can't actually get debt financing. Most of our assets are, the computers that we work on, not really bankable. So that's a building block you don't really need to consider. And then from a taxes perspective, most of us aren't profitable. We don't pay corporate income tax. So now we're down to 7 building blocks. And so when I think about, making this as simple as possible for a non-finance entrepreneur, it's you only need to think strategically about 7 different areas of the business. And if you fill out these building blocks in the right way, your income statement, your balance sheet, and your cash flow will automatically generate for you. So not to bore everyone here to death, I'm not going to touch on all 9 of these, but I will touch on 3 of them just to illustrate the point. So I'm going to talk about revenue, team, and fundraise. So revenue, this is where you're going to have the most volatility in your forecast. And this is for a couple reasons. Number one is picking a revenue model is really hard. Are you a traditional SaaS business with a subscription model? Do you need to offer some sort of consulting in order to get new clients or to get them to understand how to use the platform? Maybe you're software that needs hardware to run. Maybe you're some combination of all 3. So trying to pick a revenue model is really, really hard. Trying to predict when customers will buy is even harder. So one thing you don't have very much control over is deciding when a customer decides, yeah, I want to pay this company in order to work with them. So as far as volatility is concerned, this is the area you're going to have the greatest one. So just know that when you're building it out. Whatever revenue model you pick, you're probably going to change it. Whatever pricing you decide on, that's probably going to change too. So pick a revenue model if you're just starting out. Get started. This is how I think I will make money. Keep it simple. And just know you're going to have to continually change this as your business evolves. Where you have a lot less volatility is in expenses. And when it comes to startups, about 80% of all expenses are related to team and employee salaries. The good news about this is that if you can get your team right, your forecast from an expense perspective is already 80% done. We talk about being a little bit wrong. Well, if you can really have the team well thought out and planned out, well, you're 80% right on this test. So spend a lot of time when you're thinking about expenses on team. Now, on the downside of this, when a company needs to cut costs, maybe revenue doesn't grow as fast as they were hoping, or they need to reduce burn rate because, maybe they can't raise their next round of financing. Unfortunately, that means they probably have to make adjustments to the team. We've worked with a lot of companies. They'll call us up and say, hey, we really want to, reduce our burn rate. What are we going to do? We always say, well, we're probably going to have to look at layoffs. That's always the last area a CEO wants to look at. They're really hoping they can cut a couple software subscriptions or, cut the bubbly waters in the fridge at work, and that's going to make a significant difference. We know after this presentation that 80% of all the costs are in team. So while you can make some other adjustments in order to make, a little bit of a difference, you're generally looking at team if you're looking at expense reductions. And then finally, fundraising. I find a lot of folks overcomplicate this. They start really diving into, who they're going to like target as investors and really try to get into the nitty-gritty details of it. And while that is important long term, from a financial forecasting perspective, you're really just trying to figure out, what is the right amount of money that I'm supposed to fundraise? So things like figuring out your burn rate and how much money you need in order to achieve, 18 to 24 months of runway is really important. You can help back up your financial model by taking a look at these two things. But you also have to be honest with yourself. So, depending on your traction or overall market dynamics, you may or may not be able to raise the full amount of money that you want to. So when we started Profitual, our first round was $140,000 from five angels. That's how we got going. That wasn't enough money, enough money for me to quit my job and jump into the business full time, but it was enough money to spin up an MVP and get our first customer. After that, we raised $1 million in financing, which then we ended up, growing the team. I was able to jump into the business full time. $1 million is a really good sized round. But, even if my financial model said that, hey, Perpetual, you should raise $5 million. Well, I just knew we didn't have the traction or, I didn't have the reputation as a second or third time founder in order to raise that amount of money. So you need to be really honest with yourself and say, okay, with this financial model, how much money do I need? And do I actually have a good likelihood of being able to raise it? So you figured out these main drivers. You filled out the nine of them or seven, depending on what stage you're at. And you've been able to build a really solid financial model that has an income statement, a balance sheet, and a cash flow. Where I find even really seasoned CPAs fall short is now analyzing it. So taking a look at this financial model and what kind of story does it tell? Things like how much runway do I have? If you only have 6 months runway, I can promise you no investor is going to back you. That's too short. They want to see 18, 24 months of runway in order to back you. Is my revenue growing fast enough to attract investment? So VCs like to see doubling or tripling of revenue. If you have 10 to 15% growth, if that was my distillery, I'd be thrilled. That's great growth year over year for revenue. But for a high-tech startup that's trying to gain venture capital investment, not going to get it done. Are you spending in the key areas like R&D and sales and marketing? A lot of times we'll see companies, especially on the sales and marketing front, they'll underinvest in it. They'll have that revenue piece of doubling or tripling, but they won't be spending enough in sales and marketing. Well, if you're spending way less than your competitors in sales and marketing, how are you going to double or triple your revenue? Probably not going to happen. And then finally, how do I stack up against my peers? So, what we're really big advocates for is to take a look at key financial metrics from a KPI perspective and then benchmark them against your peers. So, calculate the metrics, but then see how you're performing against everyone else. So, here's a list of benchmarks. So, these benchmarks are targeted towards a B2B SaaS startup. You notice at the top we segregate it. So, there's a different set of benchmarks for SaaS startups that are less than 1 million in annual recurring revenue and between 1 to 5 million in annual recurring revenue. There's a whole other set of benchmarks for, companies from 5 to 20 or 20 plus million. I assumed everyone on the call might be, more like Profitual in that less than 1 million in ARR stage. So I decided to just go with these for this presentation. But it's really important that you take a look at the right set of benchmarks for your company. So here you'll see some of the things we were talking about, like, sales and marketing spend or R&D spend. This gives an idea on things like burn rate or gross margins you should be going after. But I find even, from a very high level perspective, even something like employees is interesting. So you'll take a look at the benchmark here for a startup with less than 1 million in ARR. On average, they have 7 employees. Well, I mentioned at the start of this presentation, Profitual, we have 5 employees. I don't take a look at this chart and say, hey, I need to go out and hire 2 people because the average is 7 and I only have 5. No, that would be ridiculous. I take a look at this and I say, okay, I'm pretty close to, that average. We're not, quite there, but, seems reasonable. Now, if I had 20 employees and everyone else had average of seven, that might be an interesting point of reflection for me. Why do I have so many more employees than everyone else in the company that has the same amount of revenue as I do? Am I not taking advantage of the latest AI tools? Are all of my employees, really efficient? Why isn't my revenue growing? Because based off these charts, I should be closer to the 1 to 5 million in revenue type company with 20 employees. So these benchmarks aren't a way to, take a look at them and say, okay, I need to 100% align with these benchmarks in order to have a good company. But they should be a point for you to stop and reflect and say, where do I stack up? And is there anything that I should be doing differently? The whole point of this is really to take a look at how others are performing and to see if there's any areas that you can focus on in order to get better. But what about hardware? So I talked about my last set of benchmarks are all B2B SaaS, and this slide could be what about hardware? It could be what about clean tech? It could be what about deep tech? Every time I present a set of benchmarks to a startup company, they're like, yeah, that's cool, but I'm unique for a reason X, Y, and Z. And to some degree, that's true. No two startups are alike. Like I mentioned, you can't just take a look at those average benchmarks and say, okay, if I hit all of these, I got an awesome company. No, every business is a little bit different. And hardware is no exception. So you see here, it says gross margin, a really healthy one is 60%, best in class is 70%. Well, if we go back here and we take a look at gross margin for a software company, it says the average is about 80% and top tier is actually 90% from a gross margin perspective. So these are pretty different. The difference between 60 and 80% in gross margin from a software company to a hardware company is real, and you need to take that in account for your business. What I don't like seeing is people taking a look at a set of benchmarks and saying, nope, these don't relate to me whatsoever. Totally irrelevant. I am super unique. While every business is a little bit unique, there's always a ton of value that you can get from these. Make sure though, when you are taking a look at the benchmarks, if you are a hardware company, don't be trying to get to 80 to 90% gross margin. It's probably not going to happen. So fine tune these a little bit depending on what kind of business you have, but don't just assume, oh, these benchmarks mean nothing. Look how unique I am. So you filled out your key drivers or your building blocks. You've built a financial model. You've analyzed some key KPIs. You've taken a look at the benchmarks. You're done. Well, no. Unfortunately, you need to take a look at some different scenarios. So we know these financial forecasts aren't going to be right. And the best thing you can do is to build out a couple of scenarios today so that when your business evolves and you end up, a little bit off of what you thought you were going to, you already have a plan. So what we really advocate for is having a base forecast. This is usually the one that you operate off of. This is what you're pretty sure is going to happen. Then you have a worst case forecast and a best case one. Worst case would be like something like, oh, revenue doesn't grow as fast as I thought it was going to. Well, what does that do to your burn rate? What does that do to your runway? Do you need to make adjustments to employees? Do you need to lay people off? There's a bunch of different things that you need to take a look at if something like revenue doesn't grow as fast as you thought it was going to. On the flip side of that, what if everything goes amazing? What's this best case scenario? What if revenue grows even faster than you thought you were going to have? Now you got to ramp up the team and you got to hire a bunch of people. Maybe you need to kick up a fundraise a lot, faster than you thought you were going to. These are still problems. They're good problems, but problems nevertheless that you're going to have to address. So having an idea today of, okay, I'm in my base scenario, this is how I'm operating. But you are also already know, okay, well, these are the adjustments I'd have to make if I end up in a worst case scenario, or this is what I'm gonna have to do in a best case scenario, is really, really solid financial planning. This is thinking about finance strategically. So you already have an idea today what you're going to do depending on how your business looks like, 6 months from now. All right, so now we want to manage this forecast after investment. So we built out our financial forecast. We have our three scenarios. We're able to raise money from venture capitalists. What do we do after that? So we know the plan is wrong. And your venture capitalists and your investors do as well. They don't expect any of these, Excel spreadsheets to come to fruition, 100%. So what do you do after the investment closes? What you want to do is you want to continually strive to make these things better backed by data. So at least quarterly, you want to take a look at your actuals and see where you're on or off plan. So, if you hired someone like a new developer on your team, and you take a look at your financial forecast and you don't have them built in. Well, that developer is going to continue to be with you until either they leave or you lay them off. So you should go adjust your financial forecast in order to put that new developer into your plan. Understand how it affects your burn rate and your runway. Bonus points if you actually did this before you hired the developer. That would be really awesome. But if it was something like that conference that just sprung up, that we talked about earlier in the presentation, where, okay, it's going to cost you $1,000 and you're going to go to this conference, in a couple weeks. Well, that was a one-time event. That's not something that you need to update. You don't have to go and say, okay, well, I'm going to spend $1,000 on conferences every month. So take a look at your actuals. This is where your accounting comes in really handy. At least quarterly, take a look at how you're spending money and make adjustments to your financial forecast. Startups change super fast. Everyone expects these plans to evolve. I find a lot of startup founders think that, they should have a financial forecast instead of three scenarios, and that the forecast should come true, and that investors are going to get really angry with them if they, miss revenue projections or if their expenses are higher or lower. That's not really the case. These are, really experienced finance professionals. They know the plan isn't going to be 100% accurate, and they expect things to move. The way to keep these kinds of folks happy, these investors, is to understand the plan's going to change and put new plans in front of them. Hey, now we know we're going to, have this new developer. It's increased burn rate, but I'm going to go try to find some grant funding in order to offset it. So being really upfront with your investors is really the best you can do, and let them know as the plan evolves. So on that point, if you're a startup company and, you're taking a look at these two charts, so the chart to the left is total expenses for a startup. The little dotted line says, okay, this is our financial forecast, and all the little bars that stack up are actuals. You see this is pretty close. Some months are a little under in expenses, some months are a little over. But overall, if you were to take a look at this company throughout the year, they're probably pretty much on plan. Now, if you take a look at the chart to the right on year-to-date revenue, the green line shows forecasts and then the bar charts show actuals. And, in Q1, it looks like they were pretty close to what they thought. Then it starts to widen in Q2. And by the time you get up to Q4, they're off plan by probably 50%. So you as a startup business owner don't have time to take a look at every single accounting transaction. We want the bookkeepers and the accountants to do their job. You need to think about finance strategically. So if you only have so much time in the day, should be spending your time taking a look at, the expenses and why you're off 1%. Did you buy more bubbly waters than you thought you were going to? Or should you spend your time and take a look at revenue and try to figure out, man, why did I miss my revenue by, 50% of what I thought it was going to be? That's where you should spend your time. Think strategically about this and spend your time trying to figure out why revenue was such a big miss. Do you have a pricing issue? Do you have a lead generation issue? This is where you're going to get the value from finance, is really honing in on revenue and why it was so much less than what you forecasted. So finally, how can Profitual help? So we provide free access to our platform for 30 days, no credit card required. If you want to get in and start poking around, you get full access to our financial modeling templates, all of those building blocks we've been talking about that allows you to create that income statement, balance sheet, and cash flow financial model. We also calculate all the key financial metrics and benchmark the companies. So you don't have to worry about calculating all of these and figuring out where you stack up against your peers. The platform can do all of that for you. We also have numerous discounts to well-known tech providers. I have a couple listed here, Google Cloud credits or Stripe, might be worth poking into the platform just to see if there's anything there that could save you a few bucks. And then finally, we have full download to Excel functionality. So we find investors still prefer, receiving these financial forecasts in Excel. And at the end of the 30 days, if it's, cost prohibitive for you to continue with us, you can download your Excel, and you always have your financial forecast. As a bit of an additional incentive, if you sign up today, I'll send you a couple of things. So I get Slack notifications every time someone signs up. So I'll send you tips on building a great financial forecast. This is what I would have looked for when I was an investor evaluating these. I'll send you an investor list. This is the list that we use to raise over $2 million. And then I'll also send you a simple Excel financial model. So we didn't touch on it much, but if you're a really early stage company and you're not quite ready to build this, three statement financial model with income statement, balance sheets, and cash flow, it's still not too early to start. So I can send you a really simple Excel financial model that might be the perfect stage for you just to get going as you're starting this journey. So sign up in the next 24 hours and I'll send you these three additional documents as well. Rob, that's all I had here for the presentation here today. Looks like we have plenty of time for Q&A if there is any.
Yeah, we do. Thanks so much, Ray. That was really cool. There's so much about this, and so much of the work Ala and I do in the university spaces around te with technologists. And one of the things that is really interesting is that we can't forget about the business side of the business, and that was really cool. So that was really helpful. Thank you so much. We did get one question so far. How are you integrating AI into the platform, especially for forecasting?
Yeah, so we use AI in our current version of the platform to really assist on reporting and analysis. So we link in if a company's a little bit more advanced and they have real accounting data, whether it's QuickBooks or Xero, we're able to integrate with those platforms, and we're able to use AI to do automatic analysis on even a daily basis on, where is this company performing to plan. Can we provide some recommendations based on those key metrics and benchmarking on things a business should look at in order to potentially perform better? So this is everything from analyzing things like gross margins to saying, hey, maybe we think you're spending a little bit too much or too little in these areas, and provide a recommendation in language that business owners can actually understand. So we find a lot of our competition, they build platforms made for me, like a CPA, but business owners don't speak the language of accountant always. So we try to make sure that everything in the platform is built for business owners and put in a way they can understand. And we found AI has been really useful in being able to provide the key message to our users to let them know, hey, these are the areas you need to worry about, without drowning them in CPA speak. So that's how we're currently using it. We have a new version of our platform coming out, hopefully in May. And that's where we're actually going to be using AI to make edits. So we'll be able to interact with our platform, whether it's in the platform or whether it's in Slack. And you can start asking questions like, hey, what were to happen if, my revenue decreased by 50%? What does that do to my runway? Can you add a new fundraising round of $1 million? So it's going to have an interface a lot like, whether you use ChatGPT or Gemini or any of those. And we're going to allow you to both interrogate, but also make edits to your financial model. And that's really where we see kind of the future for this is putting it in the hands of business owners so that regardless of financial background, you're able to understand the finances of your business.
And that's one of the really cool things about doing these financial modeling. And I've done a few companies over the years. And when you do the financial modeling, you develop a framework by which you can ask, what if? And if you have the robot, I use the term robot generically for the AI machine. If you ask the robot, let it do the work, you can do some really cool things. Thanks for the question. All right, we still have any more questions? There's no more questions that anyone's asked yet. If you want to raise your hand, you can ask that way. And I can stop the recording. Remember, I'm a rookie. Stop the recording, and we'll do that.